Guys, welcome back to another video. Today we are going to speak about why the Federal Reserve hikes interest rates. We're also going to speak about what is interest rates, why they hike it, how it affects the stock market, and what happens to the market when interest rates are hiked, and more to the consumer. Now, if you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please hit the like button for the YouTube algorithm. And as always, let me know down in the comments below exactly what it is that you would like for me to cover in my next video. Now, the reason why I do want to speak about the Federal Reserve interest rate is because we do have a very important meeting coming through this Wednesday on the 15th, where the Federal Reserve is expected to hike interest rates by a half a basis point. But with the most recent CPI data that came through at a 1%, at a whopping 1%, about 0.3% higher than the forecast, we can expect an aggressive interest rate hike. But if you don't understand what that mean for the economy, then how are you going to know how to trade it? So I'm going to try my best to basically explain to you guys exactly what it is and how it impacts the economy. Now, this doesn't just apply for the dollar index; it applies for for any other country in the world there as well. Now, just to keep in mind that the interest rate is basically the federal funds rate, and the target is set. The well, so it's the federal funds rate, which is known as the interest rate, is basically a target interest rate set by the FOMC. Now, this rate at which commercial banks borrow and lend their excess reserve to each other overnight. Also, the FOMC sets a target Federal Reserve rate at least 8 times over a year based on prevailing economic conditions there as well. The federal funds rate or interest rate, so just whenever I say the federal funds rate, just know I'm referring to interest rate. This can influence short-term rates on consumer loans and credit cards. And what this basically means is that if you have a loan or a credit card, you obviously know that you need to pay, you have to pay, what you call it, you have to pay interest on that, obviously. So basically what happens is that if you take out a loan at, let's say, a 1% interest, and the Federal Reserve or the central bank hikes the interest rates by 1%, then that means your interest paid on the loan would be double. Your bank would then notify you of the increase in the loan, and that means you need to pay more, which ultimately hurts you in the long term. Now, investors always keeps an eye out on the interest rates as well, because it has an impact on the stock market. And the thing is, how does interest rates affect the stock market? Now, firstly, if a company is seen as cutting, if a company is basically seen cutting back on its growth, or is less profitable either through higher debt expenses or less revenue, the estimated amount of future cash flows will then drop. All else being equal, this will lower the price of the company's stock. Now, it's important to keep in mind that as the Federal Reserve, or as the interest rate hike increases, and I've been saying this for a long time, as the interest rate hike, as the Federal Reserve keeps hiking interest rates, what tends to happen is that the stock market tends to drop. And if I bring up this chart over here, where you can see the Federal Reserve for the year, you can see this is the interest rate versus the S&P 500. The S&P 500 is this blue line, and the federal or the interest rate is these orange lines over here. Now, you can clearly see that for most of the lateral part where the interest rates were low, you can see how where the interest rates were low, you can see how the S&P 500 continued the upward momentum. Now, you can see over here, every time we had that interest rate hike here, you can see whenever the interest rates are high, the market tend to dip. And here you can see the interest rate started increasing, and we started seeing that, and you see that saw that and this is basically the last 3 times that the Federal Reserve had hiked the interest rates. Then you can see this is also this is based off last month, and you can see that every time the Federal Reserve hiked the interest rates, the stock market tends to dip. But when the interest rates are low, the stock market tends to go up. And the reason for that is the low interest rate tend to encourage consumers to spend more. And that's why we look at the CPI data to measure inflation. Now, the CPI data, which we saw came out last week, Friday. It's called the Consumer Price Index, and this measures the price. This measures goods and services. Also that measures the consumer spending overall there as well. Now, now um, not to confuse you guys. So why does the central bank basically hike the interest rates? They hike interest rates because they want to control inflation. And the way they do this is by when they hike interest rates, right? They basically encourage consumers to spend less. And as a result of that, inflation tend to slow down, or they tend to slow down the economies, which is sometimes it's a good thing. Now the reason for that basically is, if you think about this logically, right? If you have a low interest rate, right? And we're going to look at this chart very quickly. This chart over here tells us the inflation, the CPI versus the interest rates. Now, the core CPI would be this dark blue line, and the interest rate would be this line over here. Now, you can see that whenever the interest rates were low, the consumer spendings were high. Okay. Whenever the consumer spendings, the CPI, which is what we saw on Friday, whenever the CPI, sorry, whenever the interest rates are low, the CPI are high. The reason for that is low interest rates tend to attract consumers. Consumers are attractive to low interest rates. That's why when during the pandemic period, what happened basically was that the most central banks dropped their interest rates to almost zero, and this then had people come into and then started spending or acquiring a lot of debt because interest rates were so low. But what people did not know was that they were going to hike interest rates in the long term, which is why you see a lot of people are now sitting with the problem where they have a lot of debt that they're unable to attain for, because their wage or their salary is not increasing at the same rate as inflation, but their debt are increasing as a result of the Federal Reserve hiking their interest rates. But this is what I wanted to show you guys, is that you can see here, when the interest rates are low, consumers tend to spend a lot of money, because this is what attracts people to spend money when interest rates are low. Okay, now let's go back to the chart over here. Now, next thing we are going to speak about is, interest rate also affects the housing market. Now, well, not the housing, but more, it's got a massive impact on bond prices and the return on the certificate deposit, which are the CDS and the treasury bonds and treasury bills. And basically they have an inverse relationship between bond prices and interest rates. As interest rates rise, bond prices tend to fall, and vice versa. The longer the maturity of the bond, the more it fluctuates in accordance to the changes in interest rates there as well. Now, basically what happens in a situation like this is if you have people that had accumulated so much debt over a long period of time, right? So basically what happens now is that a lot of people, because interest rates are so high, a lot of people won't be able to afford to either buy a property because of high interest rate prices. If you bought a house maybe in 2020 at a zero during the pandemic, at a zero interest rate, you'd have probably seen the housing market took off. But because interest rates are starting to increase, less people are able to afford or are able to qualify or either to buy these properties. Then as a result of that, the housing market will see a steady decline there as well. Now, most of you are not that focused on the housing market, because most of you basically just wants to know what impact this has on the stock market as well as the trading market in general. Now, the next thing we are going to speak about is what happens when interest rates are generally increased basically. So when the Feds act to increase the discounted rate or the interest rate, it immediately elevates short-term borrowing costs for financial institutions. Now, this has a ripple effect, right? On virtually all other borrowing costs for companies and consumers in the economy. So you have what you got. You've got the central bank at the top of the list. Now the central bank is the banks for the bank. So you have what is known as the central bank at the top, right? So you got the central bank sitting right at the top. Now the central bank is the banks for the banks. He's the boss. Now what the central bank does is that the central bank then go and pass that interest rate. If the Fed says, okay, we're going to go to 1.75, he passed that onto, the Federal Reserve then passes that onto your bank. I'm just going to say your bank. I'm just going to call it your bank because we've got different banks. So the central bank then passes that interest rate decision, the interest rate, the new interest rate hike, pass it on to the bank. What the bank does is the bank says, okay, well, this is not my problem. The bank then passes that on to the consumer. And this is where you sit at the bottom of the food chain. So this is how the chain works basically. Now also it costs financial institutions more to borrow money. These same financial institutions often increase rates, the rates they charge their customers to borrow money. So individual consumers are impacted through increases through their credit cards and their mortgages interest rates as well. Now think about it this way: if these loans carry a variable interest rate, when the interest rate for credit cards and mortgages increases, the amount that consumers spend decreases. Now it's quite sad if you think about it, and we're going to go over that very shortly as well. Now, consumers still have to pay their bills. Okay, when those bills become more expensive, households are left with less disposable income. When consumers have less discretionary spending money, businesses' revenue and profits decrease. Okay, think of it in this way. So the consumer is now having to pay back the bank at a higher interest rate, right? CPI also increases the prices of food and services. So we're going to say here, the consumer now needs to pay back a higher interest rate, right? We have food prices increasing as well, right? So you got the price, you got prices of food that are increasing on the other side. Okay, let me just do that. Okay, guys, I'm not a designer, but I'm just trying to explain it to you guys so that you can understand how this works. So you have the consumer that needs to pay back the bank at a higher interest rate, right? So the consumer needs to pay back a high interest rate. The consumer also needs to buy food, right? So the consumer needs to buy food also. Now, the prices of food had also increased because we can see that prices of goods and services had increased time over time. If you look at the core CPI as well as the CPI. Now, if you think that's the end of the line, we also now know that the price of fuel had also increased. So now you've got US oil, and I'm just going to call it US oil, and oil is getting very expensive there. Sorry, it's getting very expensive there as well. So you got oil prices, you got food prices that's on the rise, you got interest rates, and I'm going to add that over here as well. And I want you guys to just, to just follow me as I go on this journey. So you got interest rates on the rise as well. So you have this year that the consumer has to pay. This is on the rise. So you have that, and I'm going to put this here so that it makes a lot more sense. So you have that over there as well. This is also on the rise. And then, so now a consumer needs to pay. Now, interest rates is made up of, you can bullet point this further to add a home loan increases, car, if you took a car on finance, that increases as well. And if you took a home on a loan, that increases as well. Food prices becomes more expensive. The price of oil is increasing. The only problem is we have one little problem, my friends, and that is left with wages. And I want to say this: wages is not wages does not align very well with that. So and I'm not going to say wages go down, but wages does not fall in line with inflation. What that means is that inflation has been growing at a rapid rate, but wages, is not able to keep up at the same growth as that. So as a result of that, consumers are going to get to a situation where they will not be able to sustain the debt as well. Now, remember, higher interest rates at the end of the day impacts companies negatively as well. Now, because of that, consumers are going to spend less, because after all of this had happened to them, they'll have less money to spend. And if you have less money to spend, that means you can't go to the store, and stores listed on the NASDAQ 100 will be less likely to make money. As a result of that, you'll see the stock market, right? Because the stock market makes money through consumers. Let's do this as well. Consumer spending. So you have consumer spending, which is the consumer, and these consumers. Let me go here. Sorry about that, guys. Let's go stock market. We have the stock market over here. Stock market. I sort of just become an artist myself. So this is yeah, we've got inflation over here, right? So this is the inflation. So we're gonna say wage versus inflation, right? So we have this over here, okay? This is your wages versus your inflation. Now, how does this impact the stock market? Now, consumers spend a lot of money buying Apple Watches and all of these things, and all of these companies, Amazon products and all of that. As a result of that, the stock market then increases, right? Now, if a consumer finds them in a position where everything increases, their wages doesn't keep up with all of these prices, then that basically means that the consumer spending will then drop. Ultimately, inflation will drop. That means that the stock market, the companies on the stock market, are less likely to make money, and as a result of that, their value then drop. But with that, because companies listed on the stock market is not making enough money, now with that, what do you see? You see the unemployment. Okay, so now unemployment, because now they can't sustain based off the amount of money, unemployment over there. Okay, so now as a result of that, the unemployment, because if these companies are not making money, the rate of unemployment will then increases. And as unemployment increase and the valuation of companies decreases there as well, at the end of the day, my friends, what you are stuck with is what we call a number one, and we call this a recession. And this is how the US recession is going to play out. Now, I'm no insider trader, but this is what's going to happen. And if you study what I've just drawn here, and I know it looks very weird, but if you study what I just drawn here, you'd know exactly what to do when the Federal Reserve hike the interest rates on Wednesday, and it will give you a good edge in the market to make sure that you get in there as well. Now, I want to say thank you so much for your time. Please smash that like button for the YouTube algorithm. And as always, cheers for years.